Welcome to The Explainer. Today, we're going to pull back the curtain on how professional investing really works. We're going to see why building a solid portfolio isn't about chasing hot tips or just going with your gut, but actually a very rigorous technical process.
So let me ask you, is investing an art or a science? For a lot of people, it really feels like an art. A little bit of intuition, some timing, maybe a dash of luck. But for the pros who are building portfolios designed to last for the long haul, it's a completely different story. For them, it is absolutely a science, grounded in data and a whole lot of discipline.
And right at the heart of this scientific approach is one core concept: asset allocation. Now let's be super clear. This isn't about picking the next winning stock, no. It's a systematic, data-driven method that uses financial theory and hard analysis to spread your investments out strategically. This is the absolute bedrock of how modern portfolios are built.
Okay, so if you want to build anything, you have to know your materials, right? Well, in investing, our materials are all the different types of assets you can own.
Think of these as your basic ingredients in the kitchen. Each one behaves very, very differently because, well, they are fundamentally different. A stock means you own a tiny piece of a company. A bond is basically you acting as a lender. And of course, real estate is something you can actually touch, unlike cash. Really getting a handle on these differences in risk and return is the very first technical step.
And this visualizes the one core trade-off in pretty much all of investing. It's like a seesaw. On one end, you've got the high growth potential of stocks, but that comes with a lot of ups and downs, a lot of volatility. And on the other end, you have the stability of bonds, which tend to give you lower returns. The entire science of asset allocation is about finding the exact right balance on this seesaw that fits your financial goals.
But, just mixing these ingredients together isn't enough. The real secret, kind of the technical magic behind building a portfolio that can weather storms, is all about how these different assets interact with each other.
We've all heard that phrase, don't put all your eggs in one basket. It sounds simple, but behind that saying is an incredibly powerful technical concept. It is the engine that makes modern diversification actually work. And that concept is correlation. It's a precise statistical number that measures how two assets move in relation to each other. So think of it this way. Some assets are like two boats tied together. When one rises on a wave, the other one does too. But others are like that seesaw. When one side goes up, the other goes down. This isn't a gut feeling. It is a hard, quantifiable number.
And here's exactly how that math plays out in the real world. When you combine assets that have that seesaw effect, that negative correlation, like stocks and bonds, you can really smooth out your returns. You can see it right here. When the economy's booming, your stocks might be soaring. But in a recession, when stocks usually take a hit, those high-quality bonds can act like a cushion. This isn't just luck. This is the mathematical heart of diversification doing its job.
This insight isn't just some clever little trick. It is the absolute core of modern portfolio theory, a framework so revolutionary it actually won a Nobel Prize. It was the first time anyone had mathematically proven that an investor could reduce risk without having to sacrifice their returns just by combining assets in a very calculated way. So, this is a powerful framework, but how does it get applied to you, to an individual? Because a portfolio can't just be about abstract math. It has to be about your math, your specific goals, and your timeline.
Well, the very first step is to translate your personal psychology into numbers. We're talking about your risk tolerance, basically how well you can sleep at night when the market gets choppy. That feeling gets quantified and translated directly into these percentages. So a moderate profile isn't just a vague feeling, it's a specific recipe, just like the 60-30-10 split we see here.
And then there's your time horizon. This is another massive variable. As you can see here, an investor with decades to go before retirement can afford to have more in stocks for that growth potential. But as that retirement goal gets closer and closer, the allocation is systematically adjusted. It becomes more conservative to lock in those gains and protect the capital you've worked so hard to build.
And the analysis gets even more detailed. It looks at your risk capacity. That's not just what you're comfortable with, but what you can financially afford to lose. It also has to account for your liquidity needs, how much cash you need ready for emergencies. And maybe most importantly, it models for inflation to make sure your goals are based on what money can buy in the future, not just a dollar amount today.
But look, a portfolio isn't something you just set up once and then forget about. Not at all. It's more like a living system that's going to drift over time, and it needs ongoing, disciplined maintenance to stay healthy.
So over time, the markets are going to move, and your carefully designed portfolio is going to drift. Let's say stocks have a fantastic year. Well, that 60% target might creep up to 70%, which means your portfolio is now riskier than you actually intended. The solution is called rebalancing. This is a disciplined process of periodically selling a little of what has done well and buying what has underperformed. It forces you to sell high and buy low and brings everything back to its strategic target.
Okay, but what about the really unexpected stuff? How does a disciplined portfolio hold up in a major market crash? A true black swan event.
The answer is another highly technical process that the professionals use called stress testing. You can almost think of it like a fire drill for your portfolio.
What stress testing means is putting the portfolio through a virtual crisis. Analysts will run all these simulations, asking, how would this exact mix of assets perform if the 2008 crash happened all over again? What if inflation suddenly jumps to 10%? This kind of modeling helps find potential weak spots and make sure the portfolio is built to handle extreme pressure.
So, when you combine all of these layers, the math of correlation, the personal risk profiling, the discipline of rebalancing, and the prep work of stress testing, what you really get is a scientific process. It transforms these abstract goals we have into a tangible, mathematically balanced portfolio that is built for success.
Which really leaves us with one final thought. If building a durable financial future is, at its core, a technical problem, is the solution you're using built on a truly scientific foundation?